Okay, so we're going to be studying Chapter 20, and the objectives in this chapter are to calculate interest and maturity dates for notes, analyze and record transactions for notes payable, and also for notes receivable. In Section 20-1, we're going to be talking about promissory notes. So cash is the primary medium for exchange for business transactions. Cash is used to purchase merchandise and to pay salaries and other expenses. In turn, businesses receive cash when they sell their products or services and collect payment. The cash received can be used to purchase more merchandise, pay salaries and other expenses, or if a business does not take in enough money or at the right time, they may need to take out a loan, which is a promissory note. So that's what we're going to talk about during this chapter. So when looking at a promissory note, it always has a number, it has the date of the note, the payee, okay, so who you promise to pay the money back to, in this case is Charter State Bank. How many days you need to pay for the note. So this is a 90-day note. Principal amount is for $20,000. And the interest rate, so what they're going to charge you to give you this money, is 6%. And then finally, the maturity date. So it's due in its entirety on August 16th. Oops. And then it has the person that took the loan out. So interest on promissory notes. So interest for 1 year is basically the principal times the interest rate times the time in years. That's interest for 1 year. A lot of times that's abbreviated as P times R times T. Okay? So if you had a principal of $20,000 and your interest rate was 6%, and you had 1 year to pay this back, the interest for 1 year would be 12%, or $1,200, or 6% of $20,000. So interest for a fraction of the year is the same way. So $20,000 times 6% times 90 days divided by 360 days, and that would equal $300. Okay, it's important to note that whether you are giving a loan or whether you are the receiver of a loan, you are going to calculate interest the exact same way. Okay, and also many businesses will use 365 days a year, and then others also use 360. Both are acceptable, but the textbook will always use 360 days a year. So don't let that confuse you. Okay, so interest on promissory notes. So the maturity value, so you have the principal of $20,000 plus the interest of $300, this is for 90 days, equals $20,300, and that's the maturity value. That's what the entire loan is worth. The maturity date of promissory notes. So you're going to subtract the date of the note from the number of days in the first month. So the first month, say you take the loan out on the 18th, you're only going to have 13 days in May. Then in June, you're going to have 30. July has 31 days. And then that makes August, you'll just have 16 days. All of that will make up 90. I'll just walk through that. And then we have our terms for review. So let's go ahead and open up Aplia and do our work together 20-1. Okay, so I've got work together 20-1 opened. So let's just open up our instructions. Okay, we're going to be calculating interest, maturity dates, and maturity values for promissory notes. For each of the following promissory notes, calculate the interest on the note, the maturity date of the note, and the maturity value of the note. So first we're going to do March 3rd, has a principal of $6,000 and an interest rate of 6%, and the time is 90 days. Okay, so we know that our total days is going to be 90. Oops. And just so I don't forget, our interest rate is 6%, and our principal was $6,000. And I got all of that from here. So 90 days, 6%, and $6,000. And our first date was March 3rd. So we know that we're going to have March, April, May, June. So in order to figure out how many days in March, since we started on the 3rd, we're going to take the number of days in March, which is 31, and we're going to subtract 3, and that will give us 28. April has 30 days, and May has 31. Now to figure out our June days, I'm going to do 90 minus 31 minus 90 minus 31 for our May, minus 30 for April, and minus 28 for March. That gives us 1 day that we need here. Okay, so that can be kind of confusing because you think it starts on the 3rd. I'm going to need 3 days here. That's why you need to go ahead and just add these up and subtract it so that you can get the amount of number there, or amount of days that you still have left. Okay, so remember the fraction of the year, we're only doing it for 90 days, so we're going to do 90 divided by 360. And since I don't have a fancy calculator with the parentheses and everything, I'm going to do this first. So 90 divided by 360 gives us 0.25, and I'm going to multiply that times the principal, and then I'm going to multiply it times 6%. And the interest then will be $90. That will make our maturity value is going to be the principal plus the interest, so that'll be $6,090. And we are done now with the March 3rd note. So now let's move on to the March 18th. Let's go up and get our directions. And the March 18th is $2,000 principal, 9% for 60 days. So once again, I'm going to go ahead and put this in here so I don't forget. I already forgot. 9%, okay. I'll go ahead and put 60 divided by 360 there. So we started this in March, April, and May. Once again, we're going to take 60. No, we're going to take the number of days in March, which is 31, minus, and we started on the 18th, so we're going to minus 18. And that's going to give us our first amount of days. April will be the full month. And then let's subtract this out. 60 minus 30 minus 13. So we have 17 days remaining. Okay, so to calculate the interest, and again, I'm doing this because I don't have a fancy calendar. I'm starting with a fraction of the year. So 60 divided by 360 gives me 16.7%. I'm just going to go ahead and multiply this times our 2,000. And then I'm going to multiply it again times 0.09, which is our 9. And that gives us $30. So our interest is 30. Maturity value is principal plus interest. So that's going to be $2,030. Okay, so that's how you do that. I want you guys to go ahead and do 20-1 on your own and the 20-1 application.